With the Federal Reserve and the European Central Bank taking a little bit different route to the easing cycle that we've seen more recently, we thought we'd share some thoughts on what that looks like, where we see opportunities in the market, and maybe where there's some areas that are a little bit different than we would expect. So we'll start here with rates here in the US as well as in Europe. So in blue, Fed funds rate, in white, ECB rate. You see a very similar pattern. Obviously, the Fed funds rate a little bit higher, reached a higher peak. But more recently, kind of the right-hand side of this slide, you see the ECB continuing to cut as the Fed has leveled off late last year into this year. So that's leading to what's known as an interest rate differential that is expanding. So interest rate differential is simply the Fed funds rate minus the ECB rate. So it gives you a sense for what that spread is. And you see that here in blue. So 235 is the number as of today. As we layer on the white here, this is what the market thinks is going to happen the rest of the year. So take it for what it's worth. It's based on futures. But basically, you see a similar gap. So the ECB continuing to ease. And then as that white line peaks, the market anticipates the Fed to start easing later this year. Obviously, there's differences of opinion on that. This is just what the market says, and we're trying to set that context for you. So what are the investment implications? What do we do about this? Well, typically, higher rates lead to a stronger currency. Higher rates also lead to capital inflows into an economy, and those things are kind of interrelated. So following that path, with a stronger U.S. dollar, that would benefit importers. So we're buying with more expensive dollars, if you will. We favor companies with a U.S. focus that aren't selling goods into weaker currencies abroad. So a similar story there. If those higher rates are there, and that's the reason for the currency strength, it can eventually be a headwind to growth. And so in that environment, that would favor more defensive companies, staples, healthcare, utilities, telecom, and the like. So weaker U.S. dollar then would benefit exporters. So we're selling into stronger currencies abroad, again, would favor more global companies for the same reason. So if those lower rates are not due to an economic collapse, that would be a tailwind to growth. So we need to be in kind of the Goldilocks scenario. And if that was true, it would favor cyclicals. So things like industrials and discretionary and tech benefit from that environment. And then the commodity sensitive areas and materials and energy would also benefit from a weaker US dollar. What's interesting is, this is the academic theory, but we don't invest in a vacuum and we don't invest in a textbook. We invest in reality and in markets, and the markets have performed differently. So we bring back up our interest rate differential here in blue and white, and then we're going to overlay the US dollar relative to the euro. So a higher number for the red line will be the US dollar strengthening, a lower number will be it weakening. And we see two things. One, for most of this chart, largely follows. Obviously, currencies are a little more volatile than rates. They change every day as opposed to kind of preset meetings. So for the most part of this chart, rose as that interest rate differential went higher, settled back as it went down, and then started to rise again as it started to expand. But then we see kind of the right-hand side of this slide, we see a big 10% drop in the US dollar really starting in late February. And it's continued even into this month. So diverging dramatically from that interest rate differential chart. So why has this been the case? We've said this in various contexts, and I'm sure you've heard this. The key reason is uncertainty. So we've had policy uncertainty in regards to economic policy, in regards to trade policy. We've had policy uncertainty in regards to fiscal policy. And honestly, a kind of a disagreement or a disappointment in the market with the continuing push to expand deficits here in the US. And so it's led to capital going elsewhere, regardless of the fact that our rates are higher than they are in other developed economies. So to the extent that that uncertainty heals, we would expect to see the US dollar strengthen back into that. It's a long way to go. So I think it's anyone's guess how quickly it could get back into line, with where these differentials are. The other possibility would be that the Federal Reserve pulls rates down quicker and kind of moves towards the currency, if you will. Of the two options, that's probably less likely just given what the Federal Reserve has said themselves. Obviously, that's subject to change. So we shared on the prior slide what are the things that work in different environments. And I think in this environment, we need to look more at what the currency is doing than that interest rate differential because of the uncertainty that we see. So there's always nuance to this, again, because we invest in markets, not in a vacuum. But thought we would share our thoughts with you and appreciate you taking some time to listen to them.